So you haven't made your estimated tax payments on time, and you feel that penalty and interest adding up, that bill's going to be coming. And I started making this episode because the IRS is now sending all the penalties and interest bills for everyone who filed their extension return. I thought it would be an appropriate time to talk about this. So the current rate is actually 7%, and it compounds daily for any underpayments that should have been made throughout the year in equal quarterly installment payments. However, there is a workaround. There is a way to beat this. So let's get into how we're going to do this. So if you didn't make your estimated tax payments on time for 2025, eventually when you file, you're going to get a bill from the IRS for the underpayment. So the current rate is about 7%, it compounds daily, and it's non-deductible. Even if you mail a check in to the IRS getting Q3 all caught up, that penalty still will remain. Now there is a strategy workaround to eliminate all those penalties and interest. However, it does require a retirement account, and it does require to move around some funds. Now, how do you do this? Step 1, you take a short-term withdrawal from your 401k, your IRA, or some other qualified retirement plan account. Step 2, you ask the custodian to withhold federal income tax from that withdrawal, and that could be, say, 20%, or ideally it would be the entire estimated tax payment amount that would need to have been made until now. And step 3, within 60 days, you repay that full amount back to that retirement plan account using other funds. Now, the IRS would treat that withheld amount as if it was paid evenly throughout the year, even if it was withheld in December. So those taxes are counted as if all your estimated tax payments were made on time and evenly throughout the year. And because you put the money back within 60 days, those withdrawals are completely not taxable and not subject to early withdrawal penalties. So again, when you have a withholding from a retirement account, the IRS treats it like those payments were made evenly throughout the year. However, estimated tax payments are time sensitive. By converting what would have been an estimated payment into a withholding, you've taken advantage of how the IRS counts timing differently. Now, I want to go over some common pitfalls and issues that could arise, and these are things you want to avoid. And I'm going to put it down here to the left. So the first is the 60-day rule, as you know, is non-negotiable. You don't want to miss that 60-day window because obviously then you're going to be subject to the early withdrawal penalty as well as income taxes. So definitely you want to restore those funds within 60 days. So again, like I mentioned, you do need to have the funds ready. Either from a separate source you need to replenish it within 60 days, or you can use effectively the same funds and the net withholding amount, stub amount from other funds, and restore it within 60 days. Either way, those funds need to be restored within 60 days, or this whole thing falls apart. Number 2, you can only do one 60-day rollover per 12 months per taxpayer. Again, if you did a rollover within the last 12-month rolling period, you cannot do one again. Okay, so you only get one 60-day rollover for every 12 months and per person. Number 3, use a direct rollover if possible. Again, instruct the custodian to do this and the withholding. Don't try to DIY it as to not mess it up. Ultimately, I don't want you taking the payments trying to make the tax payments manually. They need to be withheld by the custodian so that it could qualify for this. And number 4 mistake, people try to fix this by similarly taking a year-end bonus from their business through a W-2 and having the payments via that withholding spread out evenly throughout the year in that way. But I'll tell you why that's an issue. If you take that as a bonus, you're subject to payroll taxes, and also you miss out on the qualified business income deduction for the amount of those wages. So for that reason, I would not recommend going that route. You actually end up paying even more in taxes going that route. In short, don't use payroll, use retirement plan withholdings. Now, if you're 73 or older, you have one more trick up your sleeve. So if you're 73 and older and you're subject to required minimum distributions, you can use your withholding from your RMD to cover both your RMD requirement and estimated tax shortfall. This means that you can use your RMDs to strategically get around your estimated tax payment shortfalls, later in the year. So to make full circle, if you missed your quarterly estimated tax payments in 2025 and you're facing the 7% daily compounding non-deductible penalties, don't just write a check, beat them with the 60-day rollover. It's very much a legal strategy to get yourself off the hook for that 7% penalty amount. I hope you found this helpful. Click like, subscribe, turn on notifications for any updates, and I hope to see you in the next one.